7 capital gain strategies every business owner needs to know. Business owners have many decisions to make, and financial planning can sometimes be out of sight, out of mind. But the sale of your business may be one of the biggest financial events of your life, and planning many years in advance can position you to avoid unnecessary capital gains taxes. This planning doesn't just happen at the point of sale. Capital gains affects how you structure your business, how you transition ownership, what you reinvest in after the sale, and how much you get to keep, not just today, but for the rest of your life. And yet many owners only start asking about capital gains once an offer is on the table. But by then, many of the best strategies are unfortunately off the table. But here's the good news. There are many ways to reduce, defer, or even eliminate capital gains taxes if you know what to look for and when to act. In this video, I'll walk you through the 7 capital gains strategies every business owner should know well before they exit. Whether you're planning to sell in 12 months or 12 years, these ideas can help you keep more of what you built. Hi, I'm Hank Persia, President and owner of Starboard Wealth Advisors, and also hold the Certified Exit Planner Advisor, CEPA, designation. We help high net worth business owners and retirees design smart, tax-efficient plans, especially during major life transitions like selling a business or stepping away from work. If that's the kind of clarity you're looking for, you'll find straightforward guidance here without the hype or confusion. Now, let's dive into the 7 capital gain strategies every business owner should be thinking about long before a sale ever happens. Strategy 1. Plan your exit years in advance. One of the most common business owner mistakes I see is waiting until the business is already on the market to think about taxes. If you're planning to sell in the next 3 to 5 years, now is the time to get a professional business valuation, identify your adjusted cost basis, review your entity structure, S Corp, C Corp, LLC, and forecast your tax liability. Early planning opens the door to restructuring opportunities, estate trust strategies, or even shifting income across calendar years to optimize your tax rate. The earlier you start, the more options you have to control the tax impact of your exit. Strategy 2. Use the qualified small business stock exclusion. If you own a C corporation that qualifies under Section 1202 of the IRS tax code, you may be eligible for the qualified small business stock exclusion. This allows you to exclude up to $10 million, or 10 times your basis, whichever is greater, in capital gains when you sell your shares, provided you meet certain criteria, some of which include you held the stock for at least 5 years, your company meets the gross asset limit under $50 million when the stock was issued, and the business operates in a qualified industry. This is a very powerful tax break available to founders and early investors, and timing is very important with these strategies. So talk to a professional early to determine whether your stock qualifies and how to structure around it. Strategy 3. Structure the sale using an installment plan. Rather than taking the full sales proceeds in 1 year, you may be able to spread out the gain using an installment sale. This means you receive payments over time and report capital gains proportionally as the payments come in. This approach can help you stay in a lower tax bracket, provide income over time, and reduce the risk of triggering Medicare IRMA surcharges or the net investment income tax all at once. That said, installment sales aren't always the right fit, especially if the buyer's creditworthiness is questionable, but when structured properly, it's a simple way to smooth out your tax exposure over multiple years. Strategy 4. Reinvest the sales proceeds through a 1031 exchange for real estate owners. If part of your business includes investment property or real estate, a 1031 exchange can help you postpone capital gains for many years. The rule allows you to sell appreciated property, reinvest the proceeds into like-kind real estate, and defer the capital gain as long as the exchange meets the IRS requirements. This is especially common for business owners with commercial property, rental units, or legacy family land tied to their operations. Timing and structure are critical since you only have 45 days to identify and 180 days to close on a replacement property. We also work with clients to consider Delaware statutory trusts as part of their exchange strategy, especially if they want passive income and less management. Strategy 5. Offset gains with tax loss harvesting or charitable giving. If you have other investments outside your business, consider how they can work together. Tax loss harvesting lets you sell underperforming assets to create realized losses and then use them to offset the gains from your business sale. Charitable giving, by donating appreciated stock or using a donor advised fund, you could reduce your taxable income in the year of sale. For example, Let's say you're expecting $1 million gain from the sale of your business. If you donated $100,000 in appreciated securities, that could eliminate the capital gain on those securities, plus provide you a charitable deduction. So if philanthropy is part of your legacy estate plan, this strategy could help you give more to causes you care about and less to the IRS. Strategy 6, shift ownership to family members or trusts strategically. Capital gains are based on who owns the asset, so transferring ownership before the sale can create planning opportunities, such as gifting part of the business to adult children in lower tax brackets, placing shares in a grantor trust or charitable remainder trust, or using intentionally defective grantor trusts to freeze the value for estate purposes while shifting growth to your heirs. This is an advanced planning strategy, but for large exits, it can create significant income and estate tax savings. The key is to do this well before a letter of intent is signed, otherwise the IRS may still attribute the gain to you. Strategy 7, coordinate your investment and withdrawal strategy after the sale. The tax bill doesn't end once the business is sold. Many business owners reinvest their proceeds into an investment portfolio, but you don't want to overlook strategies that can help you with the taxes on those investments going forward. This is where we help clients such as suggesting tax-efficient withdrawal strategies and tax-advantaged municipal bonds, balancing income from taxable, tax-deferred, and tax-free accounts, controlling their tax bracket in retirement, planning Roth conversions in low-income years, and optimizing estate and legacy planning. Selling the business is just one event, but what you do after the sale can have a significant financial impact over your lifetime. So let's recap the 7 capital gain strategies every business owner should know. Number 1, start exit planning years in advance. 2, use the qualified small business stock exclusion if you qualify. 3, structure an installment sale to spread out the income. 4, use a 1035 exchange for real estate assets. 5, offset gains with losses or use charitable giving. 6, shift ownership strategically through gifting or trusts. And 7, coordinate your post-sale investment and withdrawal plans. The key takeaway, the earlier you plan, the more options you have. Capital gains don't have to catch you off guard, and they don't have to derail your goals. If you're a business owner and want help designing a thoughtful exit plan that creates a plan for your wealth, let's talk. Click the link in the description below to book a free consultation. We'll walk you through your goals, your timeline, and the strategies that make sense for you before any opportunities are lost. Remember, at Starboard Wealth Advisors, your financial destination is why we're here. Thanks for watching, and if you found this helpful, make sure to watch our other videos for more clear, no fluff retirement strategies, or contact us for a simple phone or Zoom call.